Good morning and welcome to today's webinar from East Capital Group, focused on the outlook for 2025 for global emerging markets. My name is Marcus Rågmark. I'm a member of the sales team here at East Capital, and today I'm really happy to have with me Jakob Grapengiesser here in the studio in Stockholm. Jakob is the CIO of East Capital and also the lead portfolio manager for our Global Emerging Markets Sustainable Fund. And we also have Ritish with us from Mumbai on link. Ritish is Senior Analyst covering the Indian market for us. So if we kick off with you, Jakob, can you give us a snapshot of 2024 for emerging markets and how the year was?
Yeah, sure. Thanks. Well, it was all over the place. Let's be honest, right? We had some markets like China up 20%, effectively outperforming developed markets. No one really thinks that. I probably would say no one would have guessed that. But overall, emerging markets were up 8%. That was significantly underperforming developed markets. As we all know, it is the US, right, leading the developed markets and certain stocks in the US. But I would probably highlight a few things. So Latin America was difficult, especially in Brazil. We had serious macroeconomic concerns. We repositioned a bit of portfolio there. Mexico is not doing particularly well. But in Asia, I mentioned China, but a country like Taiwan was up 35%, especially led by TSMC, Taiwan Semiconductor, which is manufacturing all the chips for the AI boom, right? But it's trading at 10 times EBITDA with a 28% earnings or EBITDA growth versus 25 times EBITDA for Nvidia. And then the smaller markets, I think it was also pretty much a mixed bag.
One thing which really stands out and which we can see also here on the screen, of course, is that China returned almost 20%. I think that stands out to a lot of people. With you obviously being based in China, Jakob, what's sort of your latest feelings with regards to the situation on the ground?
Yeah, that's a good question. So the feeling from the ground is that all of these measures have not really started to reach the pockets of ordinary people. But if we take a step back, the situation in August, September last year was probably much worse than many Western observers think. Of course, China is a bit opaque, it's difficult to get data, but I know that nurses in the Sichuan province, at least what I was told, they were not getting paid their wages, etc. So there were significant problems, especially with the local governments. What then the Chinese government did is they made this pivot. They completely turned around and said, okay, we realize we have a problem and we'll fix it. Trust us. I actually want to have a picture of a car here instead of all of these pretty boring numbers. And I wrote a piece saying that it's like a car. It's completely broken down, actually. You need to fix everything. You need to fix the chassis of the car, which is refinancing the local governments. If you look then on the numbers, so it's 8% of GDP or $1.4 trillion over 5 years that will be used to refinance the local governments. That's sort of fixing the chassis, right? Then you need to replace the engine. It used to be real estate driving the Chinese economy. Now you have EVs, you have high-end machinery and other things that will be the new drivers of the economy. So you're replacing the engine. Then you need to recharge, refuel the car. That's the banking system. So that's injecting a lot of money into core tier one of the banks. And then, once this is fixed, you can repaint the car and sort of get back on the road, right? But it takes time. So I think that the Chinese economy by the end of 2025 will be in a much better stage. And I think that the average person will feel that, well, there's a bit more money in my pocket, but I also have a bit more kind of confidence, consumer confidence will increase, which means that spending will increase, which of course is important because Chinese will immediately save when they feel that they're a little bit worried about the economy.
Thank you, Jakob. This is clearly a longer discussion about the details with regards to China, but I think important conclusion anyway that our view is that 2025 will see a continuously sort of improving situation in China nevertheless. This week, of course, saw the inauguration of Trump 2.0, So if we were to touch a bit upon the risks with regards to China, such as tariffs, for example, what are your views on that?
Yeah. So first of all, I think trying to predict Trump is hard job, right? I think it's pretty hard. I think the first announcements we have seen is a bit more soft than perhaps what was expected. I think sweeping 60% tariffs and everything was pretty much what was expected. But then in this, I was told it would be in 3 steps or stages. So I think for now it looks a little bit better than expected, and Trump is a deal maker. So I think if the Chinese side makes some concessions, let's say on the sale of TikTok or half of TikTok, possibly less tariffs or no tariffs. But I think the jury is out there. Our portfolio is positioned in both a aggressive and defensive way. So for example, we have Chinese internet companies that have market cap equals to cash. How much can that company go down, right? In theory, nothing. Maybe in reality, it can go down 20%. We would have 20% discount to cash. But if there's some good news, it's also relatively good beta, right? Because then the stock price would go up. We have companies paying 10, 12% in cash dividend yields, etc. So I think our positioning in China is, we are prepared for the worst, but of course we hope for a relatively decent scenario, both in terms of stimulus and stimulus kind of feeding through, and Trump having a, let's say, constructive dialogue with China.
Thank you, Jacob. And just to remind our viewers, our approach in the Global EM Fund is to be country neutral, but of course we're able to adapt our positioning within China, for example, as well as other countries, depending on our views. Thanks, Jacob. So that's China, which is of course the largest component of the emerging markets index. We then move on to the second largest country, being India, now almost at 20% of the index. Want to kick us off with your views on India?
Yeah, I think I will leave the views to Ritish, but I just wanted to introduce with this possibly a little bit complicated slide. So for India, it's really about the long-term equation. Moody wants to make India a developed nation by 2047. Industrial activity or production will increase 23 times if you believe certain estimates until then. So it's really like explosive growth. But one way to just illustrate it is something called the acceleration phenomenon. So if you make a very simple assumption, for example, that an average income in an Indian city is $10,000. Over 3 years' time, if average income grows in line with GDP, which is a reasonable assumption, it will go from 10 to 12.5, a bit more than 3 years. But the amount of the population that will have more than $15,000 in disposable income, it will go from 5% to 20%. So it will grow 4 times. So imagine you have 4 times the amount of people that can consume certain things in only a bit more than 3 years. This is why the market is expensive. This is why companies are PE 80, 100, because if you find the winners here, obviously you will have that fantastic growth over 3 years, but maybe not only 3 years, it could be 10 years, it could be 15, 20 years, right? So we have companies like, the online savings platforms of India. We have private healthcare providers, etc. But this is just an introduction. I think India is super exciting, and I think the growth is there. Having said that, has been a little bit of turbulence on the market recently. So I'll leave the word to my colleague Ritish out of Mumbai.
Sure. Thanks, Jacob. So, the mood, as Jacob said, in Mumbai right now is a bit subdued. The country has entered a cyclical slowdown. The primary reason is that, government capex, which was the main engine for growth over the last 3 years, growing at around 30% CAGR, has kind of shrunk this year post the central elections in May. Now, this is not an aberration. This happens historically. So we expect an uptick in government capex, and the first print that we saw in November said that there were early signs of a reversal because government capex in November picked up by 21%. However, that said, the slowdown that we saw in the first 6 months has driven the GDP print down to a slight slowdown given in respect to Indian standards of around 5.4% in the last quarter that we just passed. Nevertheless, as Jacob said, the structural story for India remains extremely intact, driven by favorable demographics, stable governance. And furthermore, our corporate and our bank balance sheets have never been this strong. They are the strongest in terms of lowest leverage levels in the last 20 years. So as soon as we start seeing the next uptick, both corporates and banks will be ready to fund that growth, right? Even India is relatively insulated from global shocks that could emanate from tariffs from the incoming Trump administration, because our external balance sheets remain extremely resilient, right? And just going back to what Jacob said about Modi's 2047 target of making it a 30 trillion economy, I must add that don't forget that this is Modi's last term in office. He's 72 years old. He will be 77 by the time his term ends. He will make sure that he passes all the policies and India has all the building blocks in place to get onto that sustainable path to achieve his dream of 30 trillion by 2047. I'll stop here.
Thanks, Ritish. Our fund had another very stellar year, 2024, and particularly in India, where we delivered some 500 bips of alpha. So what are the key themes that you're looking for this year to hopefully continue this strong performance in India?
Marcus, generally, we've always liked themes that offer structural growth and themes that are uncorrelated to the cyclical slowdown that we're seeing right now. So in this line, recycling has been a theme that we've liked and we've picked up over the last year. But, recently we've also added a telecom equipment company, which is on the cusp of a huge growth trajectory because of a large order wins that are expected on the annual. And also, we've also added an instant coffee production company, which is the largest in Asia, and is going to see a significant ramp up of its new capacities that are coming on stream over the next 6 months or so.
Thanks, Ritish. So with that, we've gone through China and India. Maybe if we move back to Jacob then to sort of wrap things up, any other particular markets you'd like to highlight, and what are the sort of key themes that you're looking at for this year for emerging markets?
Yeah, so I think that emerging markets are about growth. Growth in emerging markets today might be a bit lower than it was 10 years ago, but that's still where you will find growth for the next 10 years. Our fund is expected earnings growth of 18% this year with a P ratio of 11. I think the index is at 14. So I would probably say that you can expect market growth in line with earnings growth. I think that's a reasonable assumption. We don't need any inflows to emerging markets, I think, to see that type of growth. Having said that, obviously the elephant in the room is what will investors think and do about the US market, right? Because the US market was driving returns, and at some point I think investors will start to question, S&P just kind of taken to new all-time highs, and maybe they will take some money off the table, right? And then again, where do you put that money? Probably not in Europe. There is very little growth in Europe. So emerging market, I think, is the obvious one where you would reallocate. And I think from our clients, we're also seeing a significant interest in emerging market these days. Yeah. Not so much of allocations yet, but I think the interest compared to 6 or 12 months ago is on a completely different level.
Mm. Yeah, no, I agree. And just looking at the slide here, I mean, there's a significant dispersion in valuations compared to the S&P, for example, with comparable earnings growth. Thanks, Jacob. Any final remarks? We're happy to round off there.
No, I'm happy to round it off here. I think we need to be a little bit humble. What Trump will have in mind for the world economy, for the US-China relationship, etc. But having said that, I don't think we should stress too much, because it is still only 15% of Chinese exports going to the US, not 50, but 15. It is also 15 to Europe. Mm. So 30% of Chinese exports are to Europe and the US, which means that 70% to the rest of the world. So the world is becoming quite multipolar. When I meet Chinese companies, they don't speak so much about Europe, US. They speak about, Indonesia, India, Brazil, Africa. This is where they're thinking to export their EVs, for example, right? I speak to BYD and which are the target markets for their EVs. So I think that's an important thing to remember, that the world is becoming more complicated. You have emerging markets trading with each other, and that is really benefiting China, and China is sort of taking that role. So even if we get tariffs, I'm still convinced that if you pick the right companies in a place like China, they will continue to grow. India is a bit of a different story. We have a bit of a hiccup, I think, at this point in time, but the long-term story is of course intact, right? It didn't really change. So I can't really give you like one straight answer that emerging markets will perform. No, it's a bit more complicated. I think there are a lot of nuances, but as I said, I would probably look at the fundamentals and the sort of 14% earnings growth for the index as a indication of what type of returns to expect.
Very good. Thank you, Jacob, for those closing remarks, and thank you also to Ritish. With that, I'd also like to say thank you to all of our viewers for taking the time to dial in today. I hope this gave you a good understanding of how we view the outlook for emerging markets for the year ahead. As always, we're more than happy to set up individual calls, either to discuss emerging markets in general and, of course, our Global Emerging Markets Sustainable Fund in more detail. So with that, thanks a lot and hope to see you soon.